Hello, welcome everyone. As you're arriving, I'll invite you to please turn your camera on and type into chat where in the world you're joining us from today. So I'm joining from Winston-Salem, North Carolina. Oh, we have Alberta, Canada. All right, Cynthia. I'm going to Canada this summer. Looking forward to it. We have Matt from Omaha. Oh, NorCal. All right. Harrisburg, Pennsylvania. Ron, my brother went to school up there in Pennsylvania. Oh, we have someone coming from India. Fantastic. John from Boston. John, I lived in Boston for a little while. Love it there. Giorgio from Italy. Giorgio, that's where my family came from when they immigrated to the US on my mom's side, from Naples and Palermo. Okay, from Lebanon, we have Germany. That's where the other half of my family's from. Welcome, Robert. Miami. Chris Stockton from Winston-Salem. Whoa, Chris. I live right near Haynes Mall. Let's go get a beer after this, after the webinar. Fantastic. We have Pat from Bethlehem. All right, Pat. I had a bunch of friends in high school from Bethlehem. I grew up in New Jersey. Wake Forest, Ontario, Malaysia. Wow, okay, fantastic. Well, welcome everybody. We're gonna and Steve is from Brussels. Wow, we have quite an international crowd. This is fantastic. So we're gonna just go ahead and jump right into things here. We're at 12:03. I'm sure some other folks will be coming along. We'll go ahead and get started. And I would like to start by saying thank you. If it weren't for the people you see here on the screen, I would not be where I am today. And I want to start off with Dr. Van Tharp and Dr. Ken Long. The systems that we're going to be talking about today were born from a combination of Van's teachings and Ken's teachings. And I have the belief that my success proves the value of my teachers' teachings, and Van Tharp and Ken Long are my trading teachers. I thank Van Tharp and VTI because my participation in the Super Trader program was a profoundly transformative experience for me. Van's teachings, in fact, are what set me on the journey from being a losing trader to a profitable trader. When I first started trading as an uneducated retail trader, one of the first things I learned is that trading options can be an excellent way to lose money very quickly. And I also learned that trading a system that doesn't fit you helps to really accelerate that process. So when I started off, I made all the mistakes possible. I blew up more than one account. And then I met Van, and through him, I met Ken. And now Tharp Think is at the core of everything I do and everything we're going to talk about during our webinar today. Ken Long, in my opinion, is one of the most brilliant trading minds out there and just an absolute gem of a human being. Not only, in my opinion, is he an amazing teacher, an amazing trader, an amazing coach, but he's created a fantastic community of traders and great people around him. And I think actually we may have several of Ken's students on the call with us here today. I first learned about monthly asset allocation systems from Ken. That was in 2011 at a workshop at VTI in Cary, North Carolina. And since 2011, I've been trading a number of different configurations continuously since then. In fact, actually, the monthly systems that I learned from Ken were the first systems I ever traded profitably and was able to meet my objectives with, which for me was a very welcome change from my earlier experiences with options. So needless to say, my experiences with Ken have made just absolutely a huge difference. Don Scheidt is my dad. He is the first generation in our family to go to college and was doing computerized trading in the mid-'80s, around the same time as Ed Seykota and some of the other legendary traders of that era. And of course, computerized trading in the 80s was really cutting edge. He successfully accomplished his trading objective of paying for 2 college educations. And he started off, when he started, he just actually told me this last year, he didn't even have enough money for his own computer. He borrowed one from a friend. So I really admire what he was able to do, and without the benefit of all the training and education available to all of us in the trading world today. And finally, Mamadi Keita is a master drummer from Guinea, West Africa, my teacher, and also Sanji Tom is my Tai Chi master. And both of those guys exemplified for me what it looks like to live a life focused on the cultivation of mastery and how to use that in the service of others. And so they are my model for the pursuit and application of mastery in trading. Now, please consider yourself disclaimed in all the ways listed here. I want to specifically say that everything we're going to talk about today is educational, and nothing here is intended for use as a source of investment, trading, tax, or legal advice. In this presentation, I'm going to talk about systems I trade, trading vehicles I use, position sizing algorithms, all that stuff. None of that is a recommendation or advice or a solicitation to buy or sell any asset or any product. Also, a lot of the data we're going to look at today is backtest data. And as you probably know, of course, past performance does not guarantee future results, and backtest data obviously has some inherent limitations. Of course, trading involves risk, and nothing that we're going to talk about today is any kind of guarantee. Also, I do want to say this, as you'll see, I'm actively trading the systems that I'm going to be sharing with you today. So you should assume that I may or may not already have positions in the systems and the instruments that we're going to be talking about here. Okay, so let's look at an overview of what we're going to talk about today. So we're going to begin by looking at the market beliefs behind the monthly asset allocation systems. From there, we're going to look at system edges, and then we'll go on to take a look at results. And finally, we'll finish with question and answer. And just as a heads up, as we go through our time together here today, so that I can give you my full attention while I'm presenting, I won't be monitoring chat. So as we go along, if you drop a question in chat and I don't respond, I promise I'm not ignoring you. We will have a specific question and answer session at the end, and that way I can give your questions my full attention. All right, so let's go for agenda item number 1. Let's talk about beliefs and edges. So we're going to take a look at the top 3 market beliefs behind these systems. There are more than 3, but these are 3 of the most important and most impactful. So belief number 1 is that market volatility will continue to increase as the pace of change in the world continues to accelerate. So I believe that this will manifest not only in the size and speed of market drops and gains, but also in the size and locations of capital flows between global markets. So as an example of the increasing size and speed of market drops, during the COVID crash, S&P took only 22 days to drop 30% from its record high in February of 2020. And so that's the fastest drop of this magnitude in the history of the stock market. So in terms of the size and allocation, size and locations of capital flows between global markets, one belief that I have personally is that with emerging economies making such huge developmental strides that in our lifetimes, we may actually witness a changing of the guard in terms of economic hegemony. For example, the publication Focus Economics, they're predicting, I just read that Libya will be the 5th fastest growing economy in the world over the next few years. Now, earlier in my own lifetime, Libya was high on the list of places I would have thought would be destroyed by violence and war. And now it's going to be the 5th fastest growing economy in the world. So I believe things are going to continue to change. They're going to change faster than ever, and they're going to change in ways that we might not expect. So that's belief number 1. Belief number 2, institutional money will continue to move the markets as it repositions between global market sectors, searching for returns and seeking to manage risk. According to Investopedia, I just read this a couple of weeks ago, 80% of the volume of trades on the NYSE is from institutional investors. And according to Seeking Alpha, the 10 largest of those institutional investors control more than $40 trillion in assets. 40 trillion, that is a lot of money. It's controlled by only the 10 largest institutional investors, and that kind of money can really move the markets. So belief number 3 is that the 2 factors above will create an enormous opportunity for agile investors and agile money market managers, money managers, who can align their portfolios with these trends. So I believe that having a systematic, quantitative, and academically rigorous system for identifying these trends and positioning our portfolio to take advantage of these capital flows is going to be an enormous edge. I heard Ken Long call it whale watching. So we look where the big money is flowing and we go there. So what I really want to highlight here on this slide is overall the speed of global change and the amount of global change is going to create huge opportunity, but that's also going to be accompanied by increased risk. So the question is, how do we take advantage of the opportunity in a systematic and risk managed way? How do we take advantage in a systematic and risk managed way? And the monthly asset allocation systems that we're going to talk about today are one answer to that question. Now, I've been running my mouth here for a while, so I want to check in with you all. And I'm curious to see if any of you share any of these market beliefs, not as a referendum about whose beliefs are right or wrong. Remember, Van Tharp always said that there are no right beliefs, there's no wrong beliefs. There may be examined beliefs, unexamined beliefs, helpful beliefs, unhelpful beliefs, but no right or wrong. So I'm going to invite you to share in chat, if you would please. Type into chat the number that corresponds with any of these beliefs that you may happen to share. So for example, if you share belief number 1, type number 1 into chat. If you share belief 1 and 3, type 1 and 3, etc. And if you don't share any, that's okay too. Also, if you just can't be bothered to type into chat, that's also fine. Going back to right or wrong, I really like the way Dr. David Hawkins phrases it. He says, trying to apply the valuations of right and wrong to certain domains of human experience is like trying to measure temperature with a ruler. I love that. I think that's just fantastic. Oh, so we have a lot. I'm watching chat here. So we have a lot of, some folks say 3 out of 3, number 1 and 3, 1, 2, 3. Yep, 1 and 3, 2, all 3 make sense. Yep, 3, 1, 1, 2, and 3. So it sounds like we actually have a lot of shared beliefs in common on our call today. Fantastic. Sounds like we're all kind of starting the conversation in the same place. That's great. Thanks for your responses in chat there. Okay, so the next thing we're going to take a look at are the edges of the systems that we're talking about today. So first of all, these systems are academically rigorous. They are an extension of numerous momentum and portfolio moving average concepts tested in scholarly literature. So you can see the work of David Aronson for a good literature review, along with Kenneth R. French. Excellent research has also been done by Gary Antonacci, Gerald and Marvin Appel, Robert Miner, David Voman, Vijay Singhal. The list goes on and on. And last and certainly not least, Dr. Ken Long has done an incredible amount of research on the concepts behind this system, these systems, and that has been replicated, verified, expanded on by a number of traders from Ken Long's tortoise trading community. And of course, Ken Long is how we've all arrived here today. So that's the first edge. Second edge is that these systems apply systems thinking to portfolio management and asset allocation. So first of all, there's a large amount of research out there that points to the fact that asset allocation decisions account for the vast majority of portfolio performance. Like something like 90% or more of performance is accounted for by asset allocation. So focusing on this area is a major key to long-term investment success. And beyond just focusing on asset allocation, actually applying systems thinking to asset allocation is an incredibly enormous edge. I can't overstate it. I mean, right here, when we start to talk about systems thinking, we've just entered a completely different domain. This opens up a world that's not available to your average buy and hold investment advisors, your retail investors, your mom and pop stock pickers, Robinhood heroes, et cetera, et cetera. For those of us who've been around Ken Long and Van Tharp, sometimes systems thinking is like the water we swim in, and it's easy to take it for granted. What water says the fish, right? But don't underestimate the power of water. And I say this because I started as an uneducated retail trader. I mentioned all the accounts I blew up when I first started. So I know that world. And then later I ran a registered investment advisor business with my business partner at the time. So I also know the buy and hold world. So the number of people in those worlds applying systems thinking to what they're doing is a number approaching zero. Systems thinking is a hugely powerful context. when it comes to generating results. This is an absolutely enormous edge. Edge number 3, these systems can be applied to restrictive retirement accounts, even the most restrictive retirement accounts where fund choices are limited and frequency of transactions are limited. As an example, my wife is a university professor, and the funds that her employer offers in her retirement account are certainly not excellent. They're fine for what they are, but they're definitely not excellent. Plus, she can only rebalance once a month. And despite those limitations, I've been trading these systems in her account for more than a decade, and we're achieving outstanding results. I also know of traders who are applying these systems to government and military retirement accounts, and I understand that the fund choices there are even more restricted. So edge number 4, they're flexible. You can customize many of the elements of these systems to adjust the returns to meet your objectives and the drawdowns, so you can adjust these for your own risk tolerance. As Van Tharp says, it's important to trade a system that fits us. These systems are also very time efficient, so they have an excellent payoff for the amount of time it takes to execute. I'm currently running 4 different configurations or flavors of monthly asset allocations in 6 different accounts, and it takes me all of 1 hour per month. So if you are running just 1 or 2 flavors and 1 or 2 accounts, you're looking at minutes per month to operate these systems. Belief number 6, does not require in-depth understanding of fundamentals. Now, I want to say that I believe that fundamental analysis works in certain markets and as part of certain systems. For these systems, we leave the fundamental analysis to the fundamentalists, and we focus on price. So I'm not saying fundamentals don't work. I'm just saying that these systems don't use that information. As Van wrote in the Market Wizards book, knowledge of technical factors has little relationship to success. And I believe that the same is true for fundamental factors. We don't have to know everything fundamentally, and as we'll see, we can still get fantastic results. The next edge is that these systems use the world's most popular equity indexes, ETFs, and mutual funds. So this is what allows us to take advantage of the moves that are created by institutional money. There's big money in the big indexes, and if they're moving, we're going to know about it and participate. And by the way, this is also what helps us to be able to operate these systems in restrictive retirement accounts. So even if your choices are, let's say, for example, only the S&P, bonds, and cash, you could still operate a configuration of this system. Also, I know that, of course, many retirement accounts don't offer ETFs, but they use mutual funds instead, and it's still workable there. Like my wife's account, no ETFs, only mutual funds, the systems still work. Next edge, these systems are statistics based. So we want to think like the house. We want to put statistics and long-term probability on our side. And we apply the same rigorous mathematical analysis that we would apply to any intraday system, any swing system. But here we apply it to a system that holds longer term. And of course, that brings us right to the next edge. This system uses, or these systems they use longer term holding times to avoid market noise and capture longer term trends. So since the long-term trend of many of the world's most popular equity indexes is up, then it's logical that systems that employ longer holding times will align with and capitalize on this trend or this tendency. Also, of course, big markets tend to be noisy because there's a large number of players with differing intentions, differing timeframes, differing approaches, etc. So longer holding times helps us avoid some of that noise. One way you could think about it is this. If you're trading intraday, you're holding positions for minutes turning into hours. If you're trading swing, you're holding positions for days turning into weeks. And if you're trading monthly rebalancing, then you're holding for months turning into quarters. Another terminology we could use here that you may be familiar with is the idea of position trading. Also, these systems are robust. There is a trader in the tortoise community, in Ken Long's tortoise community, who tested 246 different configurations of monthly asset allocation systems. And he found that 104 of them had an SQN of over 3. So 104 of 246 had an SQN of over 3. According to Van Tharp, an SQN of over 3 is an excellent system. And finally, last but not least, the systems are very simple. Simplicity is an edge. So simplicity reduces cognitive load, which is a major hidden cost of trading. It improves trader efficiency, i.e. less chances of making mistakes. It reduces the degrees of freedom in a system. So that means less chance of data mining, over-optimization, et cetera, et cetera. And in designing your own flavor of this system, it's possible to keep things very, very simple and still get excellent results. So while we're here, let's do another poll in the chat so I don't just drone on and put you all to sleep. I'm curious to know if anyone is currently trading a system that shares the same edges, and if so, which ones? So please type into chat the number of the edge on our list here that corresponds to an edge you're also currently trading. So for example, if you have a system that uses simplicity as an edge, I'll invite you to type in 11. If you're trading a system that uses simplicity and robustness, I'll invite you to type 10 and 11. And again, this is not a referendum on the rightness and wrongness of anyone's edges. There is no right and wrong. So let's see what we have here. We have momentum. Oh, okay. Looks like Sean is already trading on a monthly basis. That's fantastic. Diana says 4, 5, 8, and 11. And let's see, we have Steve who says 7, 9, 11. Giorgio, yes, rotational, fantastic. Malav 1 through IBD. I'm not sure, IBD, Investors Business Daily. I'm not sure what you mean by that one. Robert 5, 6, 7, 8, 10, 11. Eric, all of them, 1 through 11. Using Sector Surfer, fantastic. Cedric 7 through 9. 3, 4, and 6. Terrace 1 through 11. Nick 3, 4, 5, 7, 9, 11. And Malav, CanSlim, got it. Yes, thank you. Cynthia, not currently in the headspace to trade rules-based discretionary trading plan. Got it, completely understand. Pat, probably have dabbled in each, but never put it together into a system I stuck with. Oh yeah, got it. John says trading a weekly dynamic trend system with ETFs. So 2, 3, 4, 5, 6, 7, 11 apply. Not sure how robust or academic. Yeah, got it. And the other John says 5, 6, 7, 9, 11. Fantastic. Wow, we have a lot of overlap, not only in beliefs like we saw earlier, but also in system edges. That's great. Well, thank you for taking a moment to drop that into chat. And what we're going to do next is we're going to take a look at results. So what I want to stress here as we're looking at results is that the systems we're going to look at are examples of configurations of monthly asset allocation systems that I personally trade. But these are by no means the only configurations of these systems. And so these are certainly not the only results that are possible. I built these particular configurations of the monthly asset allocation systems to meet my personal trading objectives. But the systems are highly flexible and they can easily be customized by each of you so that they meet your objectives. So yes, I do cover these specific configurations of the systems that we're about to look at in the courses that I teach. But more importantly, I teach you how that you can modify and build your own configurations. So in the courses I give you some example fishes, if you will, and then I also teach you how to fish for yourself. So we're going to look at a few example fishes to use that metaphor. So we're going to look at results in 3 different areas. First, we're going to look at one example of a momentum-based monthly asset allocation system that I trade. And we're going to look at backtest results for the system straight out of the box. In other words, like the classic or standard rule set. And then we'll also look at results with the addition of the optional volatility stops and shorts. Next, we'll look at monthly asset allocation systems based on the concept of portfolio moving averages. And we'll look at 2 different systems that I've built to achieve 2 different objectives. One is sustainable conservative growth with a maximum drawdown on the lower end of things. And the second is for aggressive growth, where we're okay with a higher maximum drawdown. And what I want to highlight here is that I designed these systems by starting with the objectives in mind. That's something I learned from Van. We start with our objectives and we go from there. And again, I'm highlighting this because in the courses, we'll be specifically talking about how you can research, design, and build your own flavor of any of these systems. And finally, we're going to look at a configuration of the hybrid system, which combines momentum and portfolio moving average systems into one meta system. Personally, this one is my favorite, my personal favorite. And of all the monthly asset allocation systems I trade, I have the most capital deployed with this one. And you'll see why. The performance is excellent. And for me, it's an outstanding balance of higher return with lower drawdown. So again, as we go through these results, remember that they're just examples. If you say, oh my God, this level of return is so boring, I might fall asleep, or, oh my God, that maximum drawdown is crazy, that would make me vomit. Don't worry, you can completely customize these for yourself. So let's begin with one flavor of momentum system. And again, we'll look at the out-of-the-box rule set first, and then the optional volatility stops. So this is a configuration of momentum system that I've been trading for a while. If you've studied Ken Long's BMR systems, the standard or out-of-the-box rule set that we're looking at here would look very familiar to you. And what we've got here is on the left, we have a graph where the horizontal axis is time, vertical axis is percent return. The green line is the backtest results of the system, and the blue line is the S&P 500. On the right here, we see that the system returned 693.1% for our backtest period, while the S&P returned 323%. I generated this backtest using a tool called etfreplay.com that's available on the internet at their website. And the time period we're looking at here is December 31st of 2007 through July 28th of 2023. So we have built into these data the subprime mortgage crisis, we have the COVID crash, and we have everything in between. On this slide, looking at the top section here, we see that the momentum system had a compounded annual growth rate of 14.2%, while the S&P had 9.7%. We also see the system's maximum drawdown was minus 34.3, while S&P had a maximum drawdown of minus 52.3%. The system was profitable 61% of the months in the backtest, with a best month of 28.73%. Definitely wouldn't mind that as a monthly return, and a worst month of minus 12.85%. In the bottom section down here, we see a year-by-year breakdown of return and drawdown for the system and for S&P. For me personally, I like to look at defensive performance first. So I like to say, hey, how much money can we avoid losing before we talk about how much money we can make? So I like to start off by looking at 2008. That's the year of the subprime mortgage crisis. S&P had a return of minus 36.8%, while the system only lost 8.3%. S&P had a maximum drawdown of 47.6%, and the system had only 23.7%. Defensively, I also like to look at 2022. Of course, stocks and bonds, as you remember last year, had the worst combined performance since the Great Depression. The system made 2.8% on a maximum drawdown of minus 22.4, while S&P lost 18.2% on a maximum drawdown of 24.5%. I also like to look at performance during the COVID crash. I think that's a particularly interesting year. The system had a maximum drawdown just a little bit greater than SPY, but for me, I certainly don't mind that it made 87.6%. I'll take that. As Ken Long said, from extreme conditions come extreme results. And when we look at the returns in total, we've only had 2 losing years. So that was 2008 and what do we got there? 2018. Again, as a reminder, this is just one flavor of momentum system. So if you're looking at this and saying, man, my objectives, I need a greater return or I need lesser drawdown, no worries. This is just one version. And we haven't included the optional volatility stop or short positions. And we're going to look at that in just a moment. And they really increase the return and reduce the drawdown. Before we look at those stats, for those of you who like to look at system stats as calculated by R multiples, here's how we do that. And hat tip to Ken Long and Van Tharp for this. So we look at the distribution of monthly returns generated by the system, and we treat each monthly return as a trade. And then we use the average loss as the value of 1R, and we convert each month's percent return into an R value. And then, of course, we can calculate all of our usual system stats as we do according to Tharp Think and Ken Long's teachings. So here we have 187 trades. We have a 61% win rate, a win-loss ratio of 1.6 to 1. We also have an expectancy of 0.38, which in my opinion is very strong. For me personally, when I'm evaluating systems on a swing basis or higher, I like to look for an expectancy of 0.2 or better, and this is close to double. And by the way, to translate that into percent terms, the value of 1R, our average loss, is 3.27%. So an expectancy of 0.38, that works out to an average gain of 1.24% per month. Our SQN is either 2.42 or 3.31, depending on which method of calculation you prefer. So that means by Van Tharp's definition, he would call this either a good system or an excellent system. On the cumulative R curve here, the blue line is cum R, while red, yellow, and green lines are the 10, 20, and 30 period moving averages. Overall, things are up and to the right, which is what we like to see. On the R multiple histogram, we do have losses of greater than 1R. Usually we like to see our losses capped at 1R, but this has to do with our method of calculating the value of R. So remember that to convert our monthly returns into R values, we're defining 1R to be the average loss. So of course, we're going to show losses that are greater than 1R on the histogram. Because math, as Ken Long likes to say. I love that expression, because math. My other favorite Ken Long expression is, remember, 50% of the drivers out there are below average. I just love that one. All right, let's go on. Let's take a look at the results when we add volatility stops and shorts. So for the column labeled SPY, we have the stats for the S&P 500 for our backtest period. Standard, these are the results we just looked at for the out-of-the-box momentum configuration. And then the column labeled vol stop plus short has the results for adding these options. And as a note here, in these data, the maximum drawdown for volatility stops and short numbers is calculated on a month-end basis, while S&P and Standard are calculated on a daily basis. So it's not exactly apples to apples, but it is enough to give us a bit of insight. So we see that when we add the volatility stops and shorts, our returns go from 323 to 693 to 960%. The maximum drawdown goes from minus 52 to minus 34 to minus 15. CAGR, we jump from 9.7, 14.2 up to 16.4. Our worst period decreases from 16 to 12 to 9. And our return to drawdown ratio goes from 6.2 to 20 to 61. So to summarize, I mean, the standard system already had excellent returns, and the addition of volatility stops and shorts has a big impact when it comes to increasing return and decreasing drawdown. So for those of you on the call today, if you already know and like Ken Long's BMR system, his monthly systems, you will love this evolution. Now, how do the volatility stops and shorts work? Okay, well, without giving away too much of the secret sauce, for the volatility stops, we look at a measure of the daily downside volatility of the markets as a whole. And when that volatility reaches or exceeds a certain level, we exit our equity positions. I know from my own research that meeting or exceeding this level of downside volatility generally means that there's a market decline ahead, and sometimes a larger than usual market decline. And we know that this is not a favorable condition for being long equities. Now, you'll notice that I did say daily volatility. So if you're going to add this option to your configuration, you would want to look at the markets daily. It doesn't have to be during market hours. You can look after hours if you're otherwise tied up during the day. And you don't need any special indicators for this measure of volatility. The value that we look at is available on any free market service out there. Yahoo Finance, Google. It's on the stocks app on your iPhone. Very simple metric. Now, the shorts, they evolved out of the volatility stop. I said a second ago that I know from research that meeting or exceeding this given level of daily downside volatility generally means that there's more market declines ahead. And specifically, what I found is that these downside volatility signals tend to cluster. And it makes sense, right? Increased volatility tends to beget further increased volatility. Drops in the market tend to precipitate further drops in the market. And what I found is that this phenomenon tends to happen more so in certain bear market conditions, which I've also quantified and identified in my research. So the logic is when we see one of these volatility signals and it's during these specific bear market conditions, we exit our equity positions, but instead of just moving to cash or money market or T-bills, we get short so we can profit from what tends to be further market declines ahead. Now, the shorts also do require daily monitoring instead of monthly monitoring because, as you probably know, shorts and bear markets in general tend to be more volatile than bull markets. So we don't want to give it too much room to go against us if the market is not going to drop like we anticipate. And just to reiterate, again, the volatility stop and shorts are optional. So if you can't or don't want to monitor the markets on a daily basis, no worries. The standard rule set has great performance, and there you only need to look at it once a month. In fact, I traded all of these systems for years before I created the volatility stops and shorts, and I got excellent results just monitoring monthly. Okay, so next what we're going to look at is results for the portfolio moving average systems. And we're going to look at two different configurations that I've built and am trading to achieve two different objectives. So one objective is sustainable conservative growth with lower drawdowns. And the second is for aggressive growth where we're okay with a higher maximum drawdown. And we're going to take a look at the results for these two systems and see if I was successful in meeting those objectives based on the results that we see. So this is a configuration of PMA that I've been trading for a while. This is the one with the objective of conservative, sustainable growth with drawdowns on the lower side. Again, this is a back test I generated on etfreeplay.com. Again, we're looking at December 31st, 2007 through September of 2023. So again, we have the financial crisis of 2008, the COVID crash of 2020, everything in between. On the left, the green line is the backtest of this configuration of PMA. And this time, the blue line is not the S&P 500. It's a benchmark created by ETF Replay that represents the return of an all-world 60-40 portfolio. So that is to say 60% stocks, 40% bonds, diversified across the world. Now, why would we compare our results to this benchmark instead of the S&P? Well, if you're someone who wants conservative growth and lower drawdowns, you're probably not also aggressively trying to beat the S&P. Generally speaking, those two objectives don't necessarily go hand in hand, at least not in the same portfolio anyway. If you want conservative growth and lower drawdowns, maybe you're coming from more of a traditional asset allocation, buy and hold retail investor type of mindset. So the question then becomes, if we're going to build our own system, can we do better than what we could do if we just did the old 60-40 buy and hold thing? So that's the idea of using this comparison. On the right, we see that the system had a return of 120.8% versus 116.9% for the 60-40 benchmark. And on the bottom here, we have volatility. So this is measured by the annualized standard deviation of daily returns. And we see that the backtest has a lower volatility than the benchmark. So in summary, it's telling us that we have slightly better growth than 60-40 on a good bit less volatility. Looking at the top section here, we see that the CAGR for this flavor is 5.2%, and the benchmark had a CAGR of 5.1%. So 5.2%, what does that mean? Does that meet our objective of sustainable? Well, here in the US, many financial advisors will tell you to plan on a withdrawal rate of 4% from your account when you're in retirement. Now, I'm not a financial advisor, and that's not advice. I'm just telling you what I read most often here in the US. So 5.2% growth means you can cover your withdrawal rate and still grow your capital. Now, of course, if you're paying a financial advisor, they're going to charge you at least 1%. Here, you get to keep your 1%. So we're meeting our objective for sustainable conservative growth, but what about the maximum drawdown? Well, in the top section, we see that the maximum drawdown for this configuration is minus 13.6% versus minus 34.7% for the 60/40 benchmark. So we're at roughly 1/3 of the 60/40 benchmark, which in my opinion is outstanding. Now, here's an interesting comparison. If we did want to compare this system to the S&P, we're at about half of the S&P's return, but on only 1/4 of the drawdown. So mission accomplished. We've definitely met our objective for this configuration of the system. We have sustainable conservative growth on lower drawdowns. Now, a system like this, I would think that, if someone's trying to figure out, well, how would this apply to my overall array of assets? And what I'm going to say is not advice at all. You could use this, for example, if you have money that you're going to need sooner rather than later. Maybe you're just about to retire or you're just entering retirement and you want to avoid sequence of return risk. If you're not familiar with that sequence of return risk, that's the idea that, let's say you're just about to retire, all of a sudden the stock market crashes, your account is way down, now you're retiring, so now you're taking money out of that account every month, every year, but the account is also way down. And if it's bad enough, you could be in a situation where your account never recovers in the course of your lifetime because you're continually withdrawing from it while it's down. So that's a potential idea. Again, I'm not a financial advisor, and that is not advice. So now let's take a look at our next configuration of PMA. So the objective of this configuration is aggressive growth. And with that, we're willing to accept higher drawdowns. So again, we're looking at a backtest from etfreeplay.com, 2007 to 2023. So we still have all the same time period. On the left, we have our equity curve in green. And this time the blue line is the S&P 500. Again, the rationale being, if you're going for aggressive growth and you're willing to accept higher drawdowns, you'd probably like to at least beat the S&P 500. So on the right, we see that this configuration returned 917.6%, while the benchmark returned 312%. And when we look at volatility, we see that PMA had a slightly greater volatility, about 10% greater, although the return is like 300% greater. So this is telling us that this flavor of PMA does have a much greater return than S&P and only on slightly higher volatility. So when we look at the top section, the CAGR for this flavor is 16 versus S&P 9.5. So we've definitely met our objective for aggressive growth. But what about the maximum drawdown? So in the top section here, we see that the maximum drawdown is minus 33.5 versus minus 52.3 for the S&P. So while we said we were willing to accept higher drawdowns, we actually end up with a drawdown that's less than S&P. And interestingly enough, you may have caught this already, this maximum drawdown is less than the 60/40 buy and hold drawdown that we looked at before, which was 34.7%. So if we wanted to compare this with that 60/40 benchmark, this configuration has a fractionally smaller maximum drawdown than the 60/40 buy and hold, but with a total return that's 800% greater. So have we met our objective for this configuration of the system? I would say absolutely, mission accomplished and then some. So last bit of results we're going to look at here. This is a configuration of the hybrid system. So the hybrid system combines both momentum and portfolio moving average concepts into a single meta system. And the advantage here is that the strengths and weaknesses of each method of analysis tend to balance each other out. So we get a diversification of systems all within the same system. And again, the hybrid system is just as flexible and customizable as the other two. And what we're looking at here is just one example of what you could build for yourself. The one that we're going to look at right now this is the one I mentioned before. That's personally my favorite. And this is the one that I'm using in my son's college tuition account. So we're going to just jump right into the summary statistics here. We have the S&P as compared to the hybrid for the same backtest period. So we see that we have 644% return on a maximum drawdown of only 14.1%. Our CAGR is 13.7, worst period only 6.9%, and our return to drawdown ratio is 45.7. Excellent return to drawdown ratio. I also like to look at the year-by-year performance. And again, we like to look at defense first. So starting with 2008, the hybrid system actually made money during the financial crisis, and the maximum drawdown was only 4.4% versus the S&P losing 36.8 and having a maximum drawdown of 47.6. I also like the way it played defense in 2020 during the COVID crash. The system made 56.3% on a drawdown of only 2.8%. In the meantime, the S&P had its fastest 30% drop in the history of the stock market for a maximum drawdown of 33.7. Let's see, other years, I like where it played defense. 2018, when the system had a max drawdown of only 9.8 versus 19.3 for the S&P. And in sum, when we look at our results, we've only had 2 losing years along the way, and quite small, minus 6.7, minus 3.9. So for me personally, I find these stats to be very comfortable. For those of you who like your results in terms of R multiples, here are the stats on the hybrid system. And in this case, I've added the volatility stop and the shorts in. So here we have 189 trades or months. Our win rate is 66%, win-loss ratio 1.2 to 1, very high expectancy of 0.45. Our average loss is 2.48, so that works out to be an average gain of 1.12% per month. Our SQN is either 3.24 or 4.46, depending on which method of calculation you prefer. So that means by Van's definition, he would call this an excellent system. On the QMAR curve, again, blue line is our cumulative R, red, yellow, and green are the 10, 20, and 30 period moving averages, and we're looking up to the right. And again, on our histogram, we do have losses of greater than 1R, and again, that has to do with calculating the value of 1R using the average loss. So last but not least, here we have a summary overview of backtest results for several different configurations of monthly asset allocation systems that I'm trading. But here what we've done is we've added an extra metric. On the bottom, we've added ending balance. So this is the ending balance of a hypothetical account calculated using a starting balance of 100,000, and we assume the compounded annual growth rate for 16 years of growth, right? So we're talking about the end of 2007 through 2023. And I like to look at this because for me, it gives me some context as to what's the bottom line impact. Like, yeah, I like to look at CAGR and sure, total percent return, but what does that actually mean when it comes to dollars in our account, right? You can't pay your bills in CAGR. You can only pay your bills in dollars. So starting with S&P, we end up with 427,000. If we do 60-40, we get 221,000. I think this is why a lot of retail investors are upset that they never make what the market makes. Here in green, we have our 2 different versions of momentum. So we have out-of-the-box flavor standard rule set. We end up with 838,000. When we add the volatility stops and shorts, we jump to 1.14 million. Here in the blue, we have 3 different flavors of PMA. I've labeled these low, medium, and high. Low is the system we looked at where we were looking for conservative growth with lower drawdowns. High is the system we looked at where we wanted aggressive growth and we were okay with higher drawdowns. And medium is exactly what you think it is. It's right in the middle. So here we go from 225,000 to 501,000 to 1.07 million. And then here we have hybrid with the volatility stops and shorts, and we end up with 780,130. So we're going to do question and answer here in just a second. And before we do that, I want to get out in front of a common question, frequently asked question. And that is, what's the difference between the momentum-based systems and the portfolio moving average systems? Well, they both can be operated on a monthly basis, although it is also possible to build a version that operates quarterly, bi-weekly, or even weekly. Both types of systems apply systems thinking to asset allocation, which is a huge edge. They're both configurable to meet your objectives, so you can build flavors of these for conservative growth, aggressive growth, etc. They both cover the world market model, and you can include as many or as few markets as you like. You can include commodities, you can include real estate, whatever you're interested in or whatever you have available. And of course, that brings us to the next point. They're both operable in restricted retirement accounts, where you might have limitations in terms of fund availability or frequency of transaction. But the main difference is in their main method of market analysis. The momentum-based systems are built around the concept of momentum, and the PMA systems are built around the concept of moving averages. And when I say main method of market analysis, what I mean is what's at the root of the system? What's the math behind the magic? What's the engine under the hood? A lot of times people ask, well, what's the difference? Because they're trying to figure out, which one should I choose? Should I choose one or the other? So here are two possible considerations you could take into account if that's a question that you have. Of course, there's more than just these two, but here's two. So the first is familiarity. So perhaps you already understand and trade systems that utilize either momentum or moving averages. And if you're comfortable with that and you want to stick with that, then you could choose the same type of system. The second consideration could be diversification. So again, perhaps you already understand and trade systems that utilize either momentum or moving averages. If you want to add diversity at the system level and add a new approach, then you could choose the other type of system. Now, also, sometimes in life, the question is its own answer. Why choose one or the other? Like, why choose one or the other when you could choose both? And that's how the hybrid system was born. The hybrid system is both combined in the same system. The hybrid system was born a number of years ago, a couple of years back. I had created two excellent monthly asset allocation systems. One was PMA and the other one was momentum. And I was having trouble deciding which of these I was going to use in my son's college account. So I shared both of the systems with my friend, my trading collaborator, my business partner at the Systems Lab, Jeff Boccaccio. Some of you might know him. And I asked him his opinion. I said, hey, Jeff, which one of these should I run? And he said, well, could you do them both? And I never thought about that. So I went and researched some different ways of making that happen. And it turns out that the results are excellent. They balance each other out really nicely. You end up with a diversification in one meta system, and you can run it all in the same account. So life is good. You don't have to choose one or the other. You can have both. And so I'm running a configuration of the hybrid system in my son's account. And so far, we're on track to meet our objectives, which is good because he's an intelligent kid. And I think he's going to be able to get into pretty much any school he wants to go to, which of course means a much bigger price tag. So with that, we'll turn it over to question and answer. If you'd like to learn more about these systems, you have three options. For the momentum systems, there's a live workshop coming up Saturday, October 7th, 9 a.m. to 1 p.m. Eastern Time. That's via Zoom, and the cost is $9.95. For the PMA systems, the live workshop is Saturday, October 21st, 9 a.m. to 1 p.m. Via Zoom. The cost for that is $9.95. We also do have a bundle package, which includes both live workshops plus a free hybrid system e-learning course. And the normal cost of that is $1,990. However, for all of you who took the time to show up today, thank you very much. I really appreciate it. This is a coupon code that you can use to get $250 off the bundle package. And the code is VTI webinar. And that's for folks who are here today. Just to make life easy, I'll go ahead and drop the link and the coupon code into chat for you. All right, so we're going to open it to question and answer. So here's how we're going to run question and answer. If you have a question, you are welcome to type it into chat. And if you are courageous enough to unmute and just ask your question with your own human voice, you skip right to the top of the line. So if you have a question, you want to put it in chat and wait, go for it. If you want to just unmute or raise your hand, you can jump right to the top of the line. All right, so I'll start, unless anyone wants to unmute, I'll start with what we have here. And if you do want to unmute, just feel free to interrupt me because you're at the top of the line. So Donna asks in chat, what level of trading/system experience is needed to take your classes? Donna, that is a fantastic question. When I first started trading monthly asset allocations, my experience was very, very limited, including my experience included basically blowing up those accounts with options, trying to trade a system that didn't fit me. And I started trading these systems very shortly after first meeting Van and Ken. So you don't need a huge amount of trading background. And when you register for the course, I have some pre-course materials that will help explain some of the most basic concepts, get you up and running, get you what you need to know before the course. So you can take the course or any of these courses about monthly asset allocation systems with very limited trading experience. Robert asks, which PMA version is used in the hybrid? Robert, so in the hybrid system, you can use a number of different versions of PMA, and you can build your own version of PMA and then your own version of hybrid with that. In the hybrid results that we looked at today, the PMA version included there was the one that we called medium when we were looking at the overview results there towards the second to last slide. Donna also asked about Forex. Donna, that's a great question, and I got this question just over the weekend. I presented to a group of traders, and someone asked, hey, well, would these systems work on Forex? I don't know. I haven't researched it myself, but certainly you could build a configuration around Forex. So your universe of possible funds could be, instead of mutual funds and ETFs that track equity indexes, they could certainly track ETFs.
Hey, thank you for
says,
your call. Can you hear me?
Oh, yeah.
I'm taking you up on your offer of unmuting.
Fantastic.
Thanks for the webinar. Yeah, I had a question about the volatility stop. This is Sean.
Yeah,
and,
hey, Sean.
Lately the VIX has been kind of maybe a bit out of whack. Some people say it's the zero DTE options expiry, what have you. But the fear in the market just doesn't seem to be there even when we have large moves. And I'm wondering if that's affected your approach to your volatility strategy.
No, it hasn't. The VIX does not come into play at all with the volatility stop. So okay. No effect whatsoever.
So you're not actually using the VIX to get that signal?
No, VIX is not a part of the volatility stop.
Okay, thank you.
Yeah, you're welcome. Good question, Sean, and thanks for unmuting. Anyone else is welcome to unmute and just have a conversation anytime you like. In the meantime, we'll jump back to Yolanda. She says, hi, Bill, the presented results are backtest results. What are your own results from the start of doing this? Does it differ? Yolanda, great question. My results are generally in line with the results of the backtest. And there are a few differences, and the differences are mostly related to the funds available, like, for example, in my wife's retirement account. So she only has mutual funds. And so what I've done is I've reverse engineered those mutual funds to figure out what indexes do they track. And then I use those, I use matching ETFs to load into ETF Replay to generate my signals on a monthly basis. So what that means is, let's say ETF Replay says we should be holding, I don't know, IWM, right? So that's small cap growth related stocks. Well, I find a mutual fund that matches that in my wife's account, and that's one of our holdings for the month. Now, the mutual fund and the ETF, they may not have exactly the same results, but generally they are pretty close. So that's one way the results differ. And then the other way the results differ are my own mistakes as a trader. I was so frustrated with myself. Earlier this year, we got a volatility stop. I mentioned before, I'm trading these systems in 6 different accounts. And so I exited in 5. I forgot the 5th. And at the end of the year, that was an 8% mistake, which just drove me nuts. I was just so frustrated with myself, but that's part of being human. You know, we're all gonna make mistakes. So what can we do to learn from our mistakes? So I love the way Van teaches a mistake analysis methodology. So those are the 2 primary ways that they differ, but they're still on track with all the projections that I made when I started trading them. Marianne asks, could I please go back to the difference sheet? Marianne, I'm not sure if this is the one that you mean, but I'll leave that up there for a while. Hopefully that is the one. Steve, you're welcome. Steve says, thanks a lot for the seminar. My pleasure, Steve. Thanks so much. Eric says, how much does the hybrid system e-learning course cost if you don't do any of the other workshops? Eric, great question. The hybrid system e-learning course is not available unless you've learned the hybrid and the BMR systems, mostly because unless you understand those 2 systems, the hybrid system wouldn't really make much sense. There's a lot of scaffolded learning that goes into understanding the hybrid system. You have to understand the components if you're going to understand the collective. Rob asks, are the system rules fully disclosed as part of the workshop purchase price? Oh yeah, absolutely. Rob, that's a great question. When we're in the workshop, we look at the rules step by step in very precise detail. And in addition, we look at each of those rules in the context of Van Tharp's definition of what is a trading system. So you may remember or know that he has 8 different system components. So we take those system rules and we look at how they fit with those 8 different components. And then we also take each one of those rules and we look at how to tweak, to customize. I share some research I've done on changing the rules and the impact it has. So yeah, we fully disclose them and we go 100% into detail on those. Rob, my goal is that everyone who comes to the courses walks away knowing how to fish. And if you're going to know how to fish, then you got to know what the rules are for the system. So yes, we definitely do that. Thanks for asking. Great question. Bart says, no, Mike, LOL. No worries, Bart. Once an investor completes the class, the investor will have an understanding to effectively trade the course concept with a portfolio. And am I assuming there are updates to the model portfolio by VTI, or is the portfolio a standalone? Okay, I think I understand the question. I'll give you the answer to the question I think you're asking. If you're asking something different, just clarify in chat. So Bart, yes, the first part of your question, you'll have an understanding of how to trade the course with a portfolio. Absolutely. I will show you specific systems, specific portfolios that I'm trading, and you could use those. And then I'll also show you how to build your own. And in the second part of your question, I'm assuming there are updates to the model portfolio by VTI. Actually, I will be updating the model portfolio and I'll have several options for after course support, some of which will be free, some of which will be like a subscription to Patreon or paid coaching, that kind of thing. But you will have options for support afterwards. So hopefully I've understood your question and answered that for you.
Can I ask a follow-up question on that? Can you hear me?
Oh yeah, John, gotcha. What you got, bud?
I'm wondering how position sizing plays into this and like number of positions per account and size of account and how those all sort of interrelate. Can you, I assume you could use these models on different accounts, but are there limits to, like, do you need a certain size account? And do you make it so that there's always X number of positions, or yeah, how does that work?
John, great question. So I love that you're asking about position sizing because I totally geek out on that. I have Van Tharp's definitive guide to position sizing right over here. It's like my trading Bible. So you asked a couple questions, so I'm going to break it down a little bit. So how does position sizing come into play? We look at various position sizing models when we go through the course. And for me personally, the position sizing model I tend to use for these systems is called percent of equity position sizing. And in addition to looking at the models, we also run a lot of Monte Carlo simulations. And so we can look at 95% confidence intervals for all kinds of stats and how that changes when we tweak our position sizing. So yes, we do cover that in the courses. Another part of your question there was, how many positions do we hold simultaneously? And that is one of the areas where the systems are very flexible. So you can configure the systems to hold as many or as few simultaneous positions as you would like. And probably you're asking that question because, you know, if you're holding more than one correlated position, you're going to want to think about things like portfolio heat when you're taking position sizing into account. So that is certainly an area that you have a lot of control over, and you can turn that dial so that it feels comfortable for you. John, did I get all of your questions? I know you had asked.
Yeah, thanks. That's helpful.
Okay.
Is there a
Fantastic.
minimum size account?
Oh yeah, good question. John, when I first started trading these accounts, I had an account that had less than $10,000 in it and was able to apply these systems. So you don't need a huge amount of capital to run these systems at all. Thanks for the great questions. Let's see. So where did we leave off? Okay, Thomas. Thomas had asked, so I understand. Oh, how are we doing on time here, by the way? If it's past one, oh my God, we're at 1:05. All right, you guys, I'm going to stay around to answer as many questions as we have. If you got to go, no sweat. Thank you so much for coming. I know we're already over time, so if you have to run, thanks for coming. If you want to stay, I'll stay here as long as you want, or at least until I get hungry and have to go eat dinner. So back to Thomas's question. So I understand the performance stats are based on the last 16 years. Did you compare these results to any other 16-year periods, preferably randomly? Thomas, I've compared the performance stats that we looked at going back as far as 2003. That's the maximum data that I have available on ETF Replay. And then I've also taken subsets of the data that we looked at and compared it just to see how smaller time periods looked over time. So hopefully I've answered your question there. Eric says using proxy funds in momentum systems is generally fine. Eric, absolutely agree. That's my experience using proxy funds in my wife's account. Yep, it works fine. Rob asks or says, so there are no special indicators, no system code that has to be purchased or implemented. Rob, great question. When I first learned this system, I learned it from Ken Long, and we were all running the system on an Excel spreadsheet. So you can run it on an Excel spreadsheet. I like to personally use ETF Replay. They have their own website. You can sign up for them if you like. I know other people use Portfolio Visualizer. That's another service out there. So there's a lot of flexibility. You can do what works for you. There's no special indicators or system code that you have to purchase from me or anyone else to implement this. Like I said, you could build your own Excel spreadsheet and you're off and running. PK asks, if the workshop dates are not available for me, will you have replays available? PK, thanks. That's a fantastic question. Yes. If you're not available on the workshop dates, recordings will be available for 30 days after the workshop date. So if you can't make it that date, no worries. You can always watch the recording. PK, thanks for asking that. Eric says, if you can't make the dates, when will you redo or can you purchase the recordings? Yes, Eric. Yep. Same question as PK. Absolutely. You can watch the recordings for 30 days. Will I be redoing the course? I don't have any plans to redo it at the moment. So right now, the only dates we have are the October dates. Donna says, is the system web-based or downloadable software? So the system itself, Donna, the rule set itself is not web-based or downloadable. The system rules, you can write them out in a Word doc. Now, the tools that you use to run the calculations involved in the rule set, you can do that on Excel, etfreplay.com. That's a piece of web-based software. Again, it's not required. I like to use it. You can use it if you like to or not. Like I said, other people use Portfolio Visualizer. I think that might be web-based, but don't quote me on that. I've actually never used it. Sean says, thanks and have a great day. Sean, you're welcome. Thanks. You too. Samir asked, do leverage ETFs or options work with these systems? Samir, yes, they do. In fact, I've researched several configurations with 2x ETFs. And if you really wanted to go out with guns blazing, you could even research it with 3x ETFs. Absolutely. I've not done it myself, but it's completely doable. It's researchable for sure. Brendan asked, do the system work for futures? Brendan, I don't know if they work for futures or not. I haven't researched that at all. My spidey sense says if you picked far enough timeline, if you know, expiration date far enough out, that yes, they could potentially work. But again, I haven't researched that myself. Bart says, excellent. Thank you, Bill. Great job. You're welcome, Bart. Thanks for the compliment. I appreciate it. Eric says, I normally use mutual funds with the 30-year plus building models. Yeah, absolutely. Mutual, yeah, and he says VFINX, FSPTX, FSPS. Yeah, a lot of history with those. Yeah, excellent. You know, for me personally, as a researcher and as a trader, I'm of two minds in terms of how much history to look at. I like looking at a lot of history because it gives us a lot of history. So we have a lot of data to look at. But I also have a belief that more recent history may be more reflective of the nearest future. In other words, I think the longer we go, the more markets change. So perhaps the most recent history may rhyme the most with the future that's about to happen, possibly. So it's good to look at it both ways, in my opinion. Look way far back and then look recently and chunk it up into smaller bits as you go. Eric asks, are these systems in any way related to your PRX systems? No, Eric, not at all related to PRX. Completely different indicator set, different edges, different beliefs, completely different. Good question. Thanks for asking. Robert asks, do you have annual performance results for the momentum with vol stops and shorts that you can provide? Robert, I do. And here's how I'm going to do that. I'm going to make myself a note right now to make a YouTube video on that. In fact, I may have already, Robert, but if I haven't, I will. So if you guys go on YouTube, look up Applied Finance Research. I have a bunch of videos out there talking about all different aspects of these systems. And Robert, let me just make a note here to do that. So you want to know results for momentum with vol stops. And actually, Robert, you're the second person who asked today. I got an email on that this morning. So if I don't have a video on that yet, I will do that in the coming days. So just keep your eye out for that on my YouTube channel. Thanks for the question. Malachi, I hope I'm pronouncing your name right. Thank you. You're very welcome. Donna, okay, thanks. Got it. Enjoyed the presentation. Great job. Thanks for the compliment. You're very welcome. Greg says you're a fantastic presenter. Great presentation. Awesome work. Thanks, Greg. My pleasure. Really my pleasure. So we're at the bottom of the chat scroll there. Do we have any other questions? Anything anyone else would like to know? Like I said, I'm happy to stay here for as long as you like. Going once, going twice. All right. Well, thank you, everybody. I really appreciate y'all coming today. Thanks for taking the time to be here. If you have any questions, please feel free to reach out to me. And with that, Sarah, I'll turn it over to you.
Thanks so much, Bill. We appreciate you presenting for us today. And you guys can contact me at customerservice@vantharp.com if you have any questions. And a replay of this presentation will be sent out later today if you'd like to review. Thanks, everyone, and have a good week.